Tax season has arrived, and for many South Africans, the goal is simple: submit the return and move on. But what if you're leaving money on the table? Perhaps you've accepted an auto assessment without checking it properly. Maybe you're overlooking travel deductions or the benefits that come from regularly working from home. Today, we're looking at the tax filing mistakes that could be costing you money and sharing practical tips to help you file with confidence. Welcome to Everything Counts. In this bi-weekly podcast series, we frank about money and the discussions we should all be having: how to save it, how to spend it, how to grow it, its pitfalls, and how to make it work for us. On Everything Counts, we'll share the information you need to get your financial ducks in a row. Hello, I'm Mateo Khwaripe. Joining me today are two experts who deal with these issues every day. First off is Ruan van Eerden. He's a tax and exchange control specialist and senior member of the Nubis Tax Group of Tax Specialists, and Irma Lategan, a tax and fiduciary specialist at Investec. Welcome to you both to Everything Counts. Irma, I think let's start with you. Most people see tax season as a compliance exercise, right? Fill in the forms, submit the return, move on with your life, and hope that you don't owe too much when it comes to taxes. But should taxpayers be thinking differently when it comes to filing?
Hi, Matteo. Yes, taxpayers should absolutely think carefully about filing taxes. Tax filing should not be viewed as a simple compliance exercise. It is the point at which your practical tax planning is implemented and your tax position is formally reflected to SARS. So your tax return should accurately capture any changes in your financial circumstances. For instance, investments, your residency status, business interests, or if you have done restructuring in South Africa or offshore. And this is why it is so important to review your return carefully, especially if it is an auto assessment. So SARS can only work with the information available to it, and an auto assessment may not take account of changes in your circumstances. If your return does not correctly reflect your position, the tax planning you have undertaken during the year may not be properly implemented. So we as Investec Tax and Fiduciary are very much involved in our clients' tax planning.
And Irma, what would those changes be when it comes to notifying SARS of anything that you've done over the past year?
There could be many changes. For instance, if you've bought a new property that you've started to rent it out and you're earning rental income on that property, or if you've sold a capital asset and you've made a capital gain on that asset, that all needs to be reflected to SARS in your tax return, and obviously you will also be assessed on that additional income or gain. Another example could be, for instance, what we see often is people relocating or ceasing their tax residency. That is a very important one because that affects your filing date of your tax return and also on what you pay taxes, either only sourced in South Africa or your worldwide assets.
Ruan, I just want to bring you into the conversation now. Is our perspective on filing taxes too rigid? Should taxpayers approach it differently?
Thank you, Matteo. And just adding on to what Irma said there as well, it's interesting what I notice how the movement in filing a tax return and the process has changed over the years. Now, I was, I'll say, lucky or unlucky to be part of that regime at the turn of, in the early 2000s, where it was still a manual return that was being completed and you were too scared to make a mistake because you couldn't Tipex it out. So as it's moved on from where to e-filing, it's grown in the way that the data collection has happened. So when it comes to completing a tax return, it is simply just not completing a return and filing it. It should be treated, in my view, as a typical health check that needs to be done on an annual basis. Because what happens often with clients, and Irman alluded to that fact, clients' circumstances change quite often during the year. And especially when you have high earners that have more sophisticated assets and income streams, they will, for example, be required to include foreign assets in their tax return, not only at cost, but at market value. They would have to look at their remuneration structuring. They would have to reconcile offshore and local investments. They would have to look at rental and business income, trusts, donations, retirement funding, medical aid, and provisional tax, to mention but a few. And what's quite important from a tax return perspective is that it needs to tell a story. It needs to make sure that it flows coherently. It needs to ensure that it presents its position accurately so that SARS doesn't take unnecessary action further.
And Ruan, I think it's important as well to then keep note of your own numbers. Yes, you might have somebody, a third party, perhaps helping you with your taxes, but just to know what's happening within your own portfolios, the properties that you keep, some of the directorships that might have changed if you have a company, things that you might need yourself to be aware of.
Exactly. One of the classic examples that I see quite often in my practice is clients that invest in offshore companies in their personal capacities, which creates what we call controlled foreign companies. And a lot of the times, individual investors simply don't complete or disclose them on their tax returns. And it's a very classic example for SARS to go after, which of course affects your prescription periods and SARS's ability to audit you.
Then, Ruan, the auto assessments, you spoke about an era where we still had the forms that we needed to fill in, and you need to make sure that they're done quite neatly so that you can get helped at SARS quite quickly. But these days, things are online. A lot of auto assessments coming through. I know where I work, a lot of people are asking each other, did you get an auto assessment? Did you get one? How does that change the landscape of filing taxes? And is it always accurate?
Not necessarily. I think in certain cases it can be quite a risky exercise to what we call accept an auto assessment, and it's for all the intents and purposes a bit of a tacit acceptance of that auto assessment. The auto assessment or the data that is gathered by SARS is based purely on third-party data, and that third-party data may not necessarily be accurate. And if you look at third-party data, it's built from employers, banks, medical schemes, retirement funds, and other various providers, even estate agents, property transactions where interest accrues on certain transactions. Those are also fed through the system. So SARS would have the numbers, but it doesn't necessarily mean that those numbers translate into what the law should be on how a tax return is completed and what the effect of that income should be. So again, it affects more higher earners that receive auto assessment. And yes, it does happen, but it's not something that necessarily should be accepted because there are risks attached to it.
And have that regime changed for the 2026 year? Has it been updated?
It has. So for 2026, again, it's a sort of a tacit acceptance that you do, because if you do nothing, then the auto assessment is regarded as accepted by SARS, and SARS will assess you accordingly. If it's not and it's incomplete, you need to take action and you need to amend the return. And what would have normally been the case is, as a non-provisional taxpayer, you would have time to amend that return, in this case up until 23rd of October 2026. But what we've seen now for 2026, provisional taxpayers that would not normally have been within the auto assessment method are also dragged in certain circumstances, but they would have a further time period to amend their returns up until the 22nd of January of 2027. So it's important that the fact that you are placed in the auto assessment category doesn't necessarily mean that it is correct. It is risky, and you need to understand what the implications are if it is not, in fact, your true tax position.
Another classic grudge purchase for a lot of people is the medical aid and handling that as well. All you know is that it's coming off your payslip or it's coming off your income, but how do you report it then to SARS?
Often a very strange one from a medical aid perspective, because it is such a rigid process that people typically accept. Your medical aid provides you with a certificate. That certificate shows your contributions very neatly in terms of yourself and your dependents, if there are any. And it shows you any amounts that you may have expended and not been permitted to claim. Now, historically, if we look at before the period when medical scheme credits came in, there was an ability for a lot of taxpayers to claim additional tax deductions where their medical expenses exceeded their taxable income based on a certain percentage, but that has been curbed to a large extent with the medical scheme credits. So when you look at the medical scheme credits, it's very rigid in terms of your fixed amount that you can get. And to the extent that your circumstances differ, age, disability, whatever the case may be, there may be some qualifying additional credits that come in. Often we find the dispute with SARS come in is where you have the subjectivity on additional amounts. For example, high medical aid bills where you want to claim an additional medical credit based on a formula, or if you have disabilities. And of course, with the disabilities, there are specific forms that need to be filled in, signed by the medical practitioner and submitted with your return. And of course, when it comes to additional medical bills, for example, a large expense that you may have incurred, it's not an automatic deduction that you're going to get, because there is a threshold of 7.5% of taxable income that a lot of taxpayers are not aware of. So even if you have a big medical expense for the year, it doesn't guarantee an additional deduction, because a lot of higher earners will be way above the 7.5 threshold, and therefore it's a medical cost for which there is no benefit other than your credits.
Irma, is the things that you discuss perhaps with clients to say, I need more than just a tax certificate when it comes to medical aid?
Well, as Ruan alluded to, there is an additional claim that you could have on your tax return, but it's only 7.5%. It's capped at 7.5% of your income. So at 7.5% of the high income earners is a lot of money. So if you spend additional fees on medical expenses that is not covered by your medical aid, that fee must exceed 7.5% of your income before you can get any tax benefit from that. So that is something that we always tell clients is just keep record of all the additional expenses on your medical that is not paid back to you by your medical aid or covered by your medical aid. But we rarely see our clients benefit from that.
My one other aspect that I want to add to what Irma stated, there is a lot of clients also are perhaps aware of the fact that they may be able to claim additional medical aid deductions based on disability. And the disability can be mental or physical in terms of that. But the effort to go through that process is often sometimes not worth the effort. So clients will accept the fact that there's a possibility of claiming an additional deduction, but do not necessarily want to go through the administration, because once you submit that claim, you are opening yourself up to more SARS scrutiny. So I think in my view that SARS does get away to a certain extent with a lot of deductions that taxpayers are not claiming, but it's countered with the fact that the administration of supporting that is quite onerous.
And Ruan, you don't want to find yourself wrestling with the tax man. Some hard truths from Irma and Ruan. Let's take a quick tax break. After this, I'll ask the dreaded question: what happens when you get audited by the revenue collector?
I reached a point in my life where I needed a financial partner to help me take things to the next level. I was worried that switching banks would be complicated. But Investec took the time to sit down with me and understand my goals so that I could focus on the future with confidence. They even switched all my accounts for me.
Investec. Now that's private banking.
Welcome back to Everything Counts. I'm still in conversation with Ruan van Eerden, a tax and exchange control specialist and senior member of the Nubus Tax Group of Tax Specialists, and Irma Latachan, a tax and fiduciary specialist at Investec. Let's continue our conversation around the things to look out for when you're filing your taxes during this tax season. Ruan, something else that often causes a lot of confusion are travel claims, right? What should taxpayers know when it comes to this? Are we keeping slips, and what exactly are we reporting to SARS?
You're correct. Matteo, travel allowances is a classic example of one of the last bastions of tax deductions that salaried employees actually have, because it has been curtailed over the last number of years, not only by the fact that when taxpayers submit their tax returns and claim their travel claims, which I'll get to now, it's often blocked at employer level when SARS perhaps does an audit on the employer, because we found in certain cases that SARS would do an audit, a travel allowance is found to have been allocated to a particular employee, but when further scrutiny is exercised by SARS on that, they find that the employee should not have been entitled to the allowance in the first place. And it does help from a cash flow perspective, because remember, only 80% of that travel allowance is actually taxable on a monthly basis, whereas the rest of it you have to claim on assessment. And this is now where the fun starts, because once you go over to your tax return, a defensible travel claim is absolutely crucial on that. And that is where the cornerstone of that is keeping that logbook and making sure that you record your miles accurately at the beginning of the year, record it accurately during the year in terms of business and private travel, and make sure that your logbook reconciles to your vehicle mileage at the end of the year. Because reconstructing a logbook at flighting season is not acceptable, because a lot of people would often just go through their calendar, try and reconstruct that, and often there are huge gaps in place, and SARS can obviously exploit that. Also, what a lot of clients are not doing, in my view, is utilizing technology. A lot of the tracking companies have very accurate logbook systems that they can use. There are very accurate off-the-market systems that can be used as well. So there's really no excuse for a taxpayer that has a travel allowance to be scrutinized by SARS and not be able to claim the deduction on business travel that has accrued during the year. Where the complexities come in are again with higher earners, where they have more complicated benefits awarded to them. For example, the use of a company car, reimbursement of travel allowances, mixed personal and business use. And that becomes a little bit more difficult, but again, not an insurmountable task, because if that taxpayer performs his or her due diligence during the year, keeps accurate records, it should not necessarily be a target for SARS when you finally get assessed by them, because the records will be accurate and you would have done all the hard work in order to make sure that that business element doesn't get taxed as a private element on assessment.
I remember filling in my husband's travel claims on his tax returns for years, and it is such a mission to get all of that information together and to remember to keep a logbook. So, Ruan, why do you think that SARS is not auditing this aspect anymore?
I think from what I've seen is the fact that taxpayers, because of the scrutiny that has been placed on a lot of taxpayers, the reviews, the audits, the questions, the logbooks, because that pattern over the last number of years from SARS has been very consistent, taxpayers know what's coming in terms of a travel can. So if you are in receipt of a travel allowance and you are required to submit your travel claim in order to justify your business travel, you have likely been subject to a review over the last few years already. So if the documentation is accurate and SARS merely does a verification, that documentation would absolve you from an audit because the documentation has been presented in a format that's acceptable to SARS.
Can we get into the cost to company now, which I find quite interesting because a lot of us don't realize that you could be bumped up to a tax bracket when you get a promotion, or perhaps after a discussion of appraisals, you get a bump in pay. That could change your situation and how you file your taxes and where you essentially end up when it comes to the tax brackets.
Correct, Matteo. The cost to company concept is often misunderstood, and it's something that SARS does take into account when looking at an overall package of benefits, cash and otherwise, that an employee has received during a particular year of assessment. And that cost to company doesn't equate at all to your disposable income because there's a whole bunch of aspects that get taken into account in terms of basic salary, bonuses, retirement funding, medical aid, group risk cover, for example, travel, other benefits that may come into play, loans and share incentives, whatever the case may be. Now, for your higher earners, it becomes even more complicated because the packages are structured on such a basis to achieve maximum tax efficiency that's legally allowable. What does become quite interesting is, in my view, and I've seen this over the last number of years that I've done this, the 7th schedule that deals with fringe benefits quite often is a very well-drafted piece of legislation. For example, a fringe benefit on a non-cash item that you receive by virtue of employment. And what a lot of employees don't take into account, for example, is as part of their cost to company, they would be provided with a cell phone allowance or a computer allowance, which are fully taxable. Instead, you can perhaps sacrifice those cash allowances for non-cash benefits by having the use of an employer-provided computer or the use of an employer-provided cell phone, which are tax-free benefits if it's used more than 50% for business purposes. And those are the simple ways in which employees can still have a decent cost-to-company package but make it much more effective from a tax perspective.
We've seen, especially in the higher band of people that are working, professionals, those in the executive suite get paid in shares. Does that also come under a cost-to-company?
Yes, definitely. But normally those shares fall under the restricted equity instruments. So the share incentive schemes is a way to keep employees at the employer for a time period because they only vest in a certain period, say 3 years or 5 years. And once they vest, then that is a taxable event. And usually that is an income tax event. So it doesn't necessarily come into play immediately for the employee, but it is a taxable event eventually when they vest. And some of these shares still provides the employee with benefits such as dividends. And these dividends also a taxable event every 6 months or whenever the company decides to declare dividends.
Also, when we look at share incentive schemes, the taxation of a share incentive scheme is very well drafted from a legislative perspective. So there's not a lot of room to maneuver. And, that tax event that Irma speaks about on vesting is very regulated in terms of what the employer can and cannot do. So the employer must apply for a directive from SARS. The employer must follow the directive in terms of taxation, and therefore SARS gets its cut when vesting takes place.
Irma, let's now talk about a word that can make even the most diligent taxpayer quite nervous, the audit. So if SARS notifies you that you've been selected for an audit, what does that actually mean? Have you been flagged in any sort of way?
Not necessarily flagged, Matteo, but there's a difference between an audit or request that you verify the documentation that you've submitted to SARS. So essentially, both of them mean that SARS wants to take a closer look at the information that you have submitted in your tax return and confirm that it matches your actual financial circumstances. So being selected for an audit or a verification does not necessarily mean that SARS believes you have done something wrong, although a lot of our clients do feel intimidated. SARS may ask for supporting documentation, explanations, or records to verify the income, deductions, and other information reflected on your tax return. I believe the best defense is always good record keeping, as Ruan has also alluded to previously. So if taxpayers have kept proper records of their tax affairs throughout the year, they should be in a position to respond to SARS promptly and provide the information needed to complete the audit as efficiently as possible. So generally, it is not an event to panic about if you've been diligent about keeping records throughout the year.
Verification is something that I think almost every taxpayer sort of expects to happen once you've submitted your return. If there's a refund owing to you, that refund is going to be subject to a verification. And a verification is, at best, a first-level inquiry in terms of information that has been submitted, a potential mismatch, which is usually alleged more than anything else. But again, the standard letters that SARS issued don't deviate much in terms of wording. So the receipt of verification is not something that a taxpayer should necessarily be concerned about. It's a first-level inquiry, and it usually deals with the matter quite efficiently at that point in time. However, if the verification gets dragged into an audit, which is a much deeper examination of a taxpayer's affairs, that's where SARS would ask very specific information about the type of income that you may have earned, the type of capital gain that you've triggered, the type of foreign tax credit that you may be looking for. And what's always quite important there is read the letter that SARS sends you very carefully, because what you want to do is not necessarily volunteer information that is irrelevant to SARS's inquiry. You want to be very targeted, deliver what they provide, deliver what they request from you, make sure that it is provided within time, and make sure that it's uploaded correctly onto the SARS e-filing website as and when SARS requests it.
And to just stress the point, Ruan, when you're picked for something like an audit, and looking through maybe your numbers through a fine-tooth comb, it's not necessarily that SARS is trying to catch you out.
No, not often. I will sometimes find it that you may be a bit unlucky when it comes to an audit. It's sometimes a bit random in terms of when you get triggered. But sometimes there are very specific risk indicators that would trigger something, a jump in income, a reduction in assets. And it's very important to make sure that, where there are mismatches, that SARS is able to reconcile that information, or that you are able to reconcile that information.
And Irma, what are those mistakes or perhaps mishaps that we do when we have been picked for an audit?
I think the biggest mistake that people make is panic. They shouldn't panic because it is something that can be sorted out. But as Ruan said, I think that should get a tax practitioner involved as soon as possible in the whole process so that everything can be sorted out timeously, because there is a time period in which you have to submit documentation and reply to the audit to SARS. And if you panic and if you don't do it properly, then things can go horribly wrong. But taxpayers should carefully consider whether their submission reflects their real-life financial affairs and ensure to provide SARS with the relevant information to substantiate their facts. And as Ruan also mentioned, only specifically to the facts that SARS is querying in the audit. It's not necessarily the question on your entire life. It's just the facts that they are auditing.
And Ruan, I guess it's quite important then for taxpayers to prepare just in case you're chosen for an audit. What exactly would someone prepare to make sure that this process is far easier?
Again, it's very easy often for more sophisticated taxpayers to keep records on a more regular basis, on a monthly or quarterly basis, than certain taxpayers that will only do it at the end of the year when you are required to do a tax return. But again, I think in the day, the way we're living in, the time that we're living in at the moment, and the way that SARS is looking at tax compliance, which is quite aggressive, and it will likely become more aggressive over time, is for taxpayers to keep their own electronic files of data through the year. Make sure it's indexed in terms of its categories so that all your information, all your underlying data, IRP files, medical aid certificates, retirement certificates, donations, investment certificates, IT3s, capital gains are all categorized. They are all easily accessible and they are all justifiable. That's quite important because claiming an expense or justifying that a portion of your income is not taxable needs proof. One of the things that I try and do with high net worth clients specifically, or high earners, is to do what's called a wealth bridge. And that wealth bridge, I suppose it's another form could be do your own personal lifestyle audit on yourself. And that personal lifestyle audit will be simply to look at your assets at the beginning of the year, look at your assets at the end of the year, look at what the difference is between the two, and can you justify the increase in assets by an increase in income, for example. And if you cannot justify that difference, that's where the risks come in, because those are the sort of reconciliations that SARS will do in the background in order to maybe trigger a specific audit, because there is a huge mismatch between the income that you declared and your asset growth over a particular year.
So what are the 5 simple things every taxpayer can do to make sure that their taxes go well, and if they've kept record of everything, they can get a bit of a refund?
So I think importantly, what I would suggest taxpayers do is, number one, for me, it's information. Make sure that the information that you are relying on in terms of your tax return is accurate. Don't accept necessarily what SARS states in a tax return, and do your own reconciliations in terms of statements, transactions, expenses, and certificates. Also, full declaration is critically important. Declare all your income, exempt and otherwise, all your gains and losses, any other income that you may have earned, any donations that you may have made, because what you want to do is preserve your 3-year prescription period. You don't want SARS to add any argument to say that there has been non-disclosure in terms of any type of income, because non-disclosure could result in SARS auditing you beyond your 3-year period, especially when it comes to crypto-related disclosures, which we've seen is quite lacking lately. Also, claim only what you can prove. Medical credits, retirement contributions, donations, tax certificates, travel deductions, home office expenses, for example. Home office expenses is a good one because that has been curtailed over the last couple of years since COVID. SARS has made it abundantly clear that if you do seek to claim a deduction for your home office, it will be subject to a lot of scrutiny. And what that does, it puts fear in a taxpayer, and they often don't even attempt to claim a home office. But if you do, you need to have your expenses in place. Make sure that you do your correct filing. Provisional tax deadlines. Make sure that you have your data available in terms of gains, bonuses, distributions, or share streams. And then again, critically important, if you are able to do so, seek professional advice before you embark on any transaction that is complicated, because getting tax advice upfront is going to cost you way less than having to dispute it afterwards. And at the moment, SARS's track record in court is pretty successful, and they typically push taxpayers as far as possible in the dispute resolution process. Hence, it's easier to kill off an audit or investigation at the beginning stages rather than being dragged through a very expensive dispute process.
Irma, any takeaways?
I would say that it all boils down to good record keeping throughout the tax year, rather than trying to piece the information together just before filing season starts. And if you're unsure about anything, get professional advice from a tax practitioner. And then finally, full disclosure to SARS goes a long way in protecting you after the 3-year prescription period.
Well, that is a key conversation to have, especially around this time when many of us are preparing documents to file our taxes. In our next episode, Snenhlanhla Setomo, Head of Insurance Business at Investec, and Elsie Radewa, Head of Financial Services at Lightstone Property, will answer some tough questions about what happens to your home loan if you're no longer able to earn an income. A big thank you to Ruan and Irma for joining us today and sharing their insights around filing your taxes. And thank you for listening to Everything Counts. If you'd like to hear or watch more of our episodes, then subscribe on Investec Focus Radio SA on any of your favorite podcast platforms. We'll see you in a fortnight.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of the firm and should not be taken as advice or recommendations. Investec Wealth and Investment International Pty Limited, registration number 1972/008905/07, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider, license number 15886, a registered credit provider, registration number NCRCP 262. The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of the firm and should not be taken as advice or recommendations. Investec Private Banking, a division of Investec Bank Limited, a registered credit provider committed to the Code of Banking Practice as regulated by the National Financial Ombudsman.